Started then. I want to welcome you, as I mentioned earlier, to the seventh of eight of our webinars this fall on business succession planning. Our topic today is valuation, and it's related to the maximizing and minimizing value. And I think what that gets to is, depending on the type of transaction that you want to do, even though it might sound counterintuitive, you might want to minimize the value rather than maximize the value that you get for the business. So in order to talk about this issue, we got one of the best valuation guys in Northeast Ohio here, Dave Gustafson. He's with Apple Growth Partners. And I don't think there's anything about valuation that Dave does not know. So I'm going to turn it over to Dave right now, I think.
All right. Well, good morning and welcome to everybody. Thanks for joining us. Companies in succession mode usually need to know the value of the business or the stock. And as an appraiser over the years, I've been asked thousands of times to give people an appraisal or give them a value of their company or of the stock. And lots of times we see some planning going into this. Sometimes we don't. And what I've experienced over my career is that planning before a succession event or evaluation can have a huge impact on value for the goal that you're trying to attain. And therefore, when Chris was going through some topics of possible to discuss, one of the ones I've had fun with is talking about maximizing or minimizing value and how you might attain that for your clients or for your company. And Chris, I clicked over. Is that going to go forward, or does it take a minute? There we go. Okay, so let's start with an overview. Here are a few things that we plan to cover over the next, say, 40 to 50 minutes that we have allocated for the conference. First, I'll say some rules, and that's everybody needs to know the basic rules for whatever succession planning mechanism they're doing or where they're heading. And knowing those rules will help you impact value for what you're trying to attain. For example, we'll talk about definitions of value, and what I mean by that, we'll review various definitions of value, i.e. fair market value, strategic value, and want to get those into your mind because when you start to think about the various definitions of value, to start to think about which one you're going after, and we'll get to that in a minute. Also want to talk a little bit about levels of value, and I have a chart in a minute that I'll show you to sort of explain that lots of times people looking to sell the business, I'll say, want to move up the food chain for the sort of the highest and best value they can get, versus a more routine fair market value is kind of normal, what you might expect to get versus trying to attain the highest possible value. Then we're going to talk a little bit about impacting value based on what I'll say are results. And what I mean by that is, obviously the results of the business will have a considerable influence on value, and a little bit of how you would, when you might find the right time to do something, whether planning or succession or selling, but also how you present things as you're getting ready to sell. You can have some very good results, and I've had more than one client just not bother to show them off before they get ready to sell and maybe sort of understate what their company really did. And therefore, a little bit of preparation or planning ahead will allow you to show off your income statement a little better and how good the results are, or if you're doing succession planning for estate and gift, how realistic the challenges of the business are as such. Similarly, when you're looking at your balance sheet, also want to look at, do we want to clean up the balance sheet? Do we want to emphasize certain things on the balance sheet to show the buyer the strengths or the weaknesses of the business that we might be dealing with? Finally, getting down also is working down presentation. You hire investment bankers to try and help you show off your business, but also as you prepare for something, just talking not only about when you're presenting the business, but your ability to talk through an owner's ability to talk through the business for purposes of selling or for purposes of planning, so that when they're, sooner or later, if you're selling your company, somebody's going to come through and kick the tires and ask you a bunch of questions. And the better prepared you are to talk about the positive things going on or to downplay some of the minimum things. I have one client, for example, that probably 75% of their, on paper, 75% of their business is from one company. And so anyone coming in is going to see that as a huge key person risk. And what we've talked to them about is, well, when you go below the surface, for example, it's 5 different divisions with 5 different purchasing departments making that purchase decision. And in this case, they supply, they've been doing this for 10 years for this company. They hold the inventory for this company. So it really becomes a very interesting, they may have a key customer risk, but they also are almost locked into this customer, because for the customer to fire this client, they have to go open a warehouse and start inventorying stuff that they haven't touched probably in a number of years. And you certainly don't, you're not going to necessarily hide the risk of a key customer, but being prepared and being ready to talk through but they're as dependent on us as we are as them, can actually turn what might be perceived as a negative into a positive. And so we want to talk a little bit about presentation and preparation as you're going through or getting ready for evaluation or for a succession event. Next thing I was going to go over is just sort of talk about an example, and this is for the folks that are, that don't live, eat, sleep, or breathe in the valuation world or the investment banking world. Throw a little bit of the jargon and get you familiar with some of the talk or the jargon that the valuation folks, as well as an investment banker or many buyers might think. So I put up a quick example here to highlight, we have a typical, I won't say typical, but we have a very nice, solid, company whose EBITDA, and EBITDA is earnings before interest, taxes, depreciation, and amortization, is about $2 million. And for those of you running companies, why do we look at the EBITDA or EBIT, earnings before interest and taxes? It has to do with what a buyer is going to look at, or the investment banks that might want to buy look at. They don't really care how you finance your business in terms of if you finance it with debt or all equity. And they're a little bit more concerned about how much depreciation you have. But what they're looking at with an EBIT or an EBITDA is how much operating cash the business generates, and then they're going to figure out how they want to finance it, whether it's with bank debt or equity or mezz financing or any of the possible choices of financing they care to do. And they want to see what the total operating cash flow is, i.e. before all the interest, before the taxes, the depreciation and amortization, because they're also going to figure out how much CapEx they put in going forward or how they manage the balance sheet. And therefore, they tend to look at either EBIT or EBITDA. Let's say we're thinking about a nice solid company that would have maybe a multiple of 5 or 6 times, suggesting a value range for the enterprise value of the business. Another word for that's going to be total invested capital, and we'll talk about that a little more, from $10 to $12 million. Now, when you're thinking about value of the stock of the business, investment bankers tend to talk about total invested capital, but you can't spend that, because normally if you're selling the company, many buyers will have you pay off your own debt, and therefore that you'll start with this enterprise value or total invested capital, and to come up with shareholder value, you'll have to adjust that, subtract any debt that you might have. And in my example, I put $4 million as an example, but you'd also add any cash or excess assets. And in the case of my example, I have nothing there, but I have clients that, have $2 million on the books or $500,000 on the books, excess cash that they don't need. Clearly, for value purposes, you would add that in. So that even though my example here has an enterprise value from $10 to $12 million, the equity value or shareholder value is probably only $6 to $8 million for this company. Okay, now that you're familiar with a few more of the things you can expect from a buyer and investment banker, let's delve in a little bit more. There we go. I apologize if I leave a little dead air. I'm takes sometimes 10 or 15 seconds before I click a slide before it's ready to go, and therefore I'm sort of have this panic attack of is the technology going to work, or am I going to not have my slides go forward? Next, I want to talk about defining what you're valuing. And this will really vary, particularly in an estate gift environment, if you're transitioning through gifting to children or if you're doing some planning. It'll also apply if you're selling the company, because are we valuing the company as a whole? And what I mean by that is, a 100% interest in the company. You're likely to have maybe a different value, even if you're selling your company, if you have 100% interest to sell versus if you only have a 40% interest to sell, if you have a 55% or a 70% interest to sell. And again, from my last example, most investment bankers that want you to hire them, when they throw a number out about what your company's worth, they're going to throw the enterprise value or the total invested capital number out. If I'm a cynic, it's because it's a bigger number and they want to get you a bigger number, or at least sound like they're getting you a bigger number. But what I want you to, most sellers or people that are owners, think about equity value, because that's more what you can spend, or that's more what you have to plan around for estate and gift tax purposes. So if you're valuing the company as a whole, contrast that with valuing majority interest in the company. And a majority interest can be 50.1%, where you have, basically all voting control. You probably don't have maybe a liquidating control. Some states require 2/3 or more to be able to liquidate or to be able to sell without some approval of your partners. I think California has some very interesting laws about minority shareholder rights, but they vary from state to state. And therefore, valuing if I'm valuing a majority interest, you may have some slight differences in value if you're valuing 50.1 versus 2/3 versus 80%, where the person can file consolidated tax returns after acquiring an 80+% interest, to a 100% controlling interest. And so if you're planning, let's think about, can you get a block that's 100% to deal with if you're selling? Or if you're doing estate planning, I'm guessing your estate planning attorney is going to wind up with something considerably less than 100% that they want you to value. Likewise, a minority interest valuation. Clearly, when you're looking at this, do you have a 49% interest as a large minority shareholder, and are there 51% other partners? That's clearly a different value picture than if you have a 49% interest and there's a 51% partner out there that has fairly significant control. Likewise, you're going to get a different value if you have a 1% interest versus someone that has a 99% interest. And you're going to get some different interplay for there. And therefore, when you're planning, I guess my answer becomes, what do you want in terms of, or what can you get to offer a seller or for estate planning or the like? And then last but not least, we also do value debt instruments, things like that may come into play in an estate situation. If you've loaned money to the company over the years and you're the sole shareholder, then obviously your interest in the company may be your equity interest, but it may also be the debt interest you have. Next, I want to talk a little bit about I'll call it relationship of values. And everybody always asks me when I'm doing an estate valuation, am I going to get a discount, or if they want to sell the business, can I? And my answer is it always depends. And what it depends on is, where do you fit on this food chain? And what I mean by that is most people look at control value as kind of a going concern value, what an investment banker that doesn't have any strategic synergies might pay for if I have at least 50 and maybe 100% of the business. Now, if you are in a position where there may be buyers out there for synergies, there may be buyers out there that can cut expenses. I go back to any number of things in my career. I go back to when I started doing valuations, I worked for a company called Ameritrust. And in the mid-90s, Society came along, and Ameritrust was valued at $9 or $10 a share at a previous condition when the banking world wasn't doing so well. And Society came in and thought they could eliminate about $60 million of operating expense, and I think they offered $16 or $17 a share and got a deal done. solely based on their ability for, quote, synergies or expense cutting. And in some cases it may only be what they think they can do. You're never quite sure if they can actually do it at the end of the day. So you're looking for synergistic strategic value as the highest and best if you're looking for a sale transaction. And by the way, there are no guarantees that there are synergistic buyers out there, or for that matter, that they will come up to the plate and pay for you what you're worth to them. It's always nice if there are two synergistic buyers out there to start at least a bidding war, because if you may be worth $5 million as a going concern to a financial buyer, even on controlling value, even on a control basis, just because you're worth $7.5 million to somebody else because they can cut expenses, they can market your product in a broader market than you can, any number of reasons, they may not put that much money on the table for you unless there's a second strategic buyer out there that also sees similar value and makes them put that much on the table as they're getting ready to buy. In contrast, let's work our way down the chart. And in that instance, if more times than not, estate planners get paid a great deal of money to see how far down this food chain they can take a company, i.e., a minority interest value is likely to be worth less than a control value or a 100% value. Marketable minority interest value generally is perceived in the valuation community as what the stock market looks like. And what I mean by that is, yes, you can go out and trade the stock so it has relatively full marketability, but when you buy selling stocks, you don't have, if you're buying 1,000 shares of XYZ company, it's a fly on the wall to them, but it is fully tradable. So you can get out of it in 3 days when the stockbrokers close you out and write you a check for your trade that you do today. But you have no real ability to influence management, and so there's a certain level for that. And then you do see when companies are taken over or companies are sold as 100% interest, they try to work their way back up to a control sale from the marketable minority interest sale you see every day traded for at the New York Stock Exchange or on Wall Street. And then last but least, I think, in terms of value category, is a non-marketable minority interest. Again, this is what the estate planners are looking at. How bad can they make something look from the standpoint of, if you own 5% of a private company and you have a 95% shareholder, there's not a lot of people out there interested in buying your 5% interest. There's not a market for the stock. And therefore, to get somebody to buy that, you may have to take a significant discount for what it might be if 100% of the company were up for sale, because whoever is buying your 5% steps in your shoes, and the 95% shareholder pretty much tells them how it's going to work. And so we've seen lots of data over the years to demonstrate conclusively that certainly there is less value per share if you are a non-marketable minority interest shareholder. Now, as I said, if you're doing estate planning, if that picture wasn't bad enough, we certainly will have estate planning attorneys put buy-sell agreements in place that sort of make it next to impossible to sell the stock, making something that's not very marketable, even less marketable. Or from a minority interest standpoint, we've seen people give non-voting shares, which, while a 5% interest in a company is certainly minority interest, 5% of the equity that has no vote whatsoever has, less influence as a minority shareholder. And so if you're planning estate planning situations or tactics or gifting, things like that, most people want to work their way down the chart. Versus if you're looking to sell your company, you're planning to work your way up the chart, if you will, and see if you can find 1, 2, 3 strategic buyers in order to get a bidding war together. And obviously totally maximize. Not unrelated to that are, I'll say, the definitions of value. And if you're doing estate planning, the standard value, or even for that matter, ESOP or an ERISA type valuation, the first two, fair market value is an old definition out of Revenue Ruling 5960, and basically is a willing buyer, willing seller proposed transaction with both parties knowing all the facts, including whether it's a minority interest or a controlling interest, whether it's not marketable or whether it's marketable. Not dissimilarly, The second bullet here, adequate consideration applies to ESOPs, and the Department of Labor added one wrinkle because adequate consideration is basically defined as fair market value, one, but two, determined in good faith by the trustee or fiduciary. And it sort of suggests that not only you got to get the number right, but you got to have a good process. But either one of those first two bullets really are valuing the interest you have, whether it's a minority interest, how marketable that interest is, if you get a controlling interest. Usually neither A nor B will even consider a strategic interest because, fair market value is a willing buyer, willing seller. You do not assume that there's a strategic buyer out there under either of those standards. And so under the first two standards, you're looking at the company as it is, not any kind of strategic offer that might come into play as value. The third bullet, fair value, comes into play in the financial reporting. If you've bought a company and your accountant comes in and says, well, we have to, see if the goodwill has impairment, the 141, 142, 144 type rules of accounting all apply on fair value, and it has some relationship to fair market value as a standard. Likewise, shareholder actions, if someone has been frozen out of a company or if there's a dissenting shareholders action, the standard is basically fair value. And fair value will vary from state to state. In Ohio, for example, fair value allows discounts for lack of marketability and minority interest. I know, for example, in New York, fair value allows a discount for lack of marketability, but not a discount for minority interest. And so you have to look at the various state statutes in order to find out what possible discounts from the prior page may apply based on your fact circumstance.
Dave?
Yes?
Quick question. So the definition of fair value is generally a legislated definition, so it's pretty cut and dry depending on what state you live in?
The state will interpret what it is. They all tend to drift back towards fair market value, but you will have court cases in each state varying to define or a legislative standard that then gets litigated in court cases. So you'll have basic standards outlined varying from state to state for fair value.
Okay, great, thank you.
So unfortunately, if your liquidity event here is fighting, or is going to wind up in a shareholder action, fair value is the standard you're looking at to work through and plan through.
Dave, we have a question from Mel.
I'm curious about the state-by-state variance. Is that a location of the business or where the business might be incorporated?
I'm assuming it's based on state of incorporation because that's going to dictate normally where the legislation might take place or the state law that would follow should follow the state of incorporation.
Okay. Thank you.
I swear to that because I'm assuming if you have a state incorporated in Ohio but you're getting divorced in Indiana and both parties are in Indiana at the time, the divorce law will follow Indiana law, I'm quite sure. Whereas if you're doing a shareholder litigation, even though both of the shareholders may be headquartered in Indiana, if the company is incorporated in Ohio, I think you're going to find Ohio law takes precedent in that circumstance where the company is incorporated.
Just so many corporations are Delaware corporations, but they do business all over the country. So that's what kind of brought the question.
Fair enough, and the Delaware law would generally rule as such.
Okay, thank you.
We're working down again. Investment value, I guess I'll make the quick analogy here that it is the analogy to strategic value, i.e. if you're looking for that, it's a value to a specific buyer, and therefore strategic or investment value to a strategic buyer is one thing. It does happen to apply the other way, that if your buyer is not necessarily if you're not as valuable to someone else because they have a good market share in your market, they may see it as less. They should lose if they're bidding for your company to somebody else. But investment value is value to a strategic buyer, to a specific buyer. And then last but not least, intrinsic value really is kind of something the valuation community applies to. When you hear a Wall Street analyst saying this stock should be trading at $50 a share, that's what they think it's worth. It could be trading at 55 or it could be trading at 45, but their intrinsic value is what they think it's worth. Let me give you an example for the next three slides are sort of a quick example of, working your way down the chart 2 charts ago, if you will, in a fair market value situation. Let's take, for example, a family business, and whether this is 5 or 10 or the math will work out the same each way. But let's say I have a family business worth $10 million. If that goes through an estate as a 100% interest, the state's going to recognize $10 million of value and pay estate tax on a $10 million value going through that estate. So most good estate planning attorneys may do something like split up the interest amongst the family, for example. And here's not an untypical one. If you have a typical family where both mom and dad are around, have a nice 40-year marriage or 30-year marriage, have a couple kids in the business, whether they have some out of the business or not, at the very least, you may wind up having the business split up where mom will own 40, dad will own 40, and then the children, once they reach the age where they're active in the business, you might wind up gifting maybe 5 or 10% to them. And what this does is, at this rate, you see you've gone from having someone with an absolute 100% controlling interest, and obviously the value for estate purposes would be on the controlling interest line. You probably take them down to a minority interest lack of marketability. And so maybe instead of a $10 million value, you look at each of these individual shareholders individually, i.e., when you make a gift to your children, the value of the gift is what's valued. If you only give 10% to a child, whether you own the other 90 or not is irrelevant. You value based, and this is well-established law back to the Bright case in 81 and Revenue Ruling 9312, you value the 10% interest as a 10% interest, that's a minority interest that doesn't have marketability. And therefore, you'd expect discounts for lack of marketability and minority interest to apply while you're doing the gifting. And then if you've split the other interest up between mom and dad so that neither one has, 50% interest, you could wind up turning your $10 million business into 4 interests that in the aggregate maybe only add up to $6 million. And if you're doing estate planning and, have to pay tax on anything over $2 or $3 million in every estate, you can take a whole bunch of tax money off the table just by working your way down from a control value down to a non-marketable minority interest value. And there are tactics way more sophisticated than this, but this is your basic blocking and tackling type of gifting strategy in order to make sure that nobody for estate tax purposes winds up at that sort of highest estate value line of control value. I guess I'll contrast that if your exit strategy or your transition strategy is to sell or sell to an ESOP, and maybe you do have, I'm going to click back one, maybe whether you're selling to a third party or an ESOP, let's assume this isn't mom or dad, but it's 2 equal partners and each one of them has a child in the business, so that you still have 4 shareholders, nobody owns absolute control. If you're looking to sell the company, obviously the board wants to get together or the shareholders all want to get together and present a unified interest so that someone buying the company will see, yes, I can buy 100% interest so that I can pay at least a control price, and maybe we can start talking about moving up the chain further if there's a strategic offer out there, rather than selling a 40% interest that someone's not going to be too keen on because it's a minority interest in a non-marketable stock. And so this is where the planning gets into, get your ducks in order to see what you want to be to offer to sell to a third party. Likewise, if you're thinking about an ESOP, want to think with you about, it's sometimes hard to get someone to do a sale of 50% or 51% to the ESOP on day one, just because the bank may not want to lend that much money, and or you may not want them to because you don't want to incur that much leverage on your company that you've built over the years. And so we'll try and do some planning techniques of maybe the ESOP buys 30 or 40%, but we've also put buy-sell agreements in place that say if the seller sells the company any time to anybody other than the ESOP goes along at the same control price. Or the ESOP buys 30% and the ESOP gets a right for the next X number of years to buy up to 51% of the business, so that it not only gets the 30% it buys now, but it gets the right to buy control or acquire control and therefore it starts to have more attributions of a controlling interest it's buying, it maybe can pay a little bit better price than if it were solely buying, a 20% interest in a non-marketable minority interest stock. A little bit of plan. Go ahead. I'm sorry.
We have another question. Mel? Hello? Okay.
I was going to say, Mel, do you have a, yeah, I was going to say, it says question box 4. But anyway,
okay.
I'll continue on, if you will, but here's where planning comes in. Get yourself in a position to know what your outcome is, know what level of value you want to be on, because a little bit of planning will help a whole lot in the outcome of what you're trying to obtain. Next thing I want to talk about are results. And okay, it's the most obvious thing in the world on the one hand that if you're making lots of money, you're going to get a much better offer if you're selling your company, and if you're not making as much money, you're not going to get as good an offer. But I'll also suggest to you that how you present your results will affect what you actually have. And what I mean by that, for example, is you may want to clean up your income statement. I've had more than one C corporation, taxable corporation that I've worked with over the years that doesn't want to pay a lot of tax. And therefore, if you were to look at their income statement on December 30th of any given year, they may have $600,000 of pre-tax profit on their December 30th or December 31st income statement. And then everybody gets ready to close their books, and they have what I'm used to calling period 13 adjustments, which is as you're closing, and all of a sudden they decide to make $150,000 contribution to the pension plan and maybe $200,000 compensation to the owner, throw another $50,000 into each of the owner's children, and before they're done, $600,000 looks like $150,000 of C Corp taxable profit by the time the year-end financial statement is published and the tax return is published. Well, part of my comment to that is, at the very least, you want to make those plainly evident. If that's where you're at in the world, if you're doing something for a third-party sale, at the very least, let's make it obvious. And Chris, at this point, can you open the Excel spreadsheet? Because I've got 2 examples that sort of showing this expense plainly or not showing this plainly, and want to go through those quickly.
Okay, Dave, we also have a question from Mel.
Go ahead, Mel.
Listen, I apologize. I had my mute button on the last time. Dumb Irish fella. Anyway, very quickly, DOL, I have heard that the DOL has taken a very jaundiced look at valuations where the minority share discount has been diminished because of a buy-sell or a future ability to buy, or a guaranteed future ability to buy. Have you not had those kinds of problems? And if so, how have you dealt with them?
A couple things. Certainly the DOL sticks their nose in our neighborhood every now and then, and they're not keen on, it's not high on their list when they're auditing it to say no discount, for example, because you bought 30% and had the right to buy up to 51 or 55%. We've had some luck getting them to at least, make the discount be a little less than it might otherwise, so it's probably worth doing. But it doesn't go away. The other thing we found is normally it takes them 2 or 3 years to come and audit, and it doesn't hurt that if you do a 30% buy with the right to buy, or 25% buy with the right to buy 51, it certainly helps if you're working on your second stage transaction by the time they audit 2 or 3 years later, so that they have a clear path of this just wasn't paperwork, that this is real, and that by the time 3.5 years comes by, that you actually are closing on your second transaction, or the paperwork's in the process, so that you can really show this is a good faith effort, that maybe we only did a 25% buy the first time, and at the end of 3 years we're doing another 25 or another 26 in order to make sure.
Okay.
That's not to say that they'll be thrilled, but we do sort of remind them that their own proposed regulations from 1988, and they still are proposed since '88, certainly suggest that that's a viable alternative if the agreements are well drafted. But your comment is still well taken, Mel, because even with very well drafted documents and very well agreed to agreements, even maybe a voting proxy for the 21% shares that are the right to vote, they still wince a little, and you may have a little work during an audit to make them appreciate that this is a good transaction.
But if you can demonstrate actual future condition or future sales in process.
It certainly helps a little to show that money is about to change hands and the ESOP's really going to get that 51%, and it's not just paperwork that's going to sit there for 25 years before they pull the trigger and get 51% interest.
Okay, thank you.
All of those things help.
Dave, which sheet did you want?
You've got the right one up here. I'm going to use example 1 and 2 basically for a contrast.
Can everyone see that, I hope?
And please note here you've got an example 1 and 2 are going to be the exact same company, and it's a client of mine that I've been doing for a long time, and they tend to make very large bonuses at year end, and they also tend to make fairly large discretionary contributions to their profit sharing at the end of the year. And so you'll note in my one that says example 1 that the operating income of this company for 2007 was about $707,000, and that salary, wages, and in this case other benefit expenses is about $2.2 million. Now, Chris, you want to kick it over to the other example?
Okay.
Example 2, and leave it right there. Same company. Actually, leave it there because I'll like to see just a little bit more of the page. So kind. Because I've got my same company here, and salary and wages are only $731,000 to the employees, but if you're selling your company, it sure makes it a lot easier to see if you put a discretionary expense line down below to the tune of $504,000, which is the size, to tell you the size of how much money is going into the pension and a couple other discretionary items, and that the owner's taken out $630,000. Clearly, you know, one of these is going to look better to a third-party buyer, and one of these is going to be a better presentation if you're doing something for estate and gift purposes. And I think it's pretty self-evident that, you know, which of these will present itself better depending on which way you're going. I have over the years had people tell me that, you know, with respect to this discretionary expense line, that, you know, I'm making a very large, you know, we make very large contributions to our profit sharing plan, and, you know, but for our employees' benefit, because we don't want to pay tax, but that, you know, if we sold to a third party, clearly the employees would all stay even without these large contributions year in and year out. And I guess I will at least pose the question to you that if that's truly the case, and if you truly think your successor owner is would be able to take out, you know, maybe 4 of the $500,000 of discretionary items, I'm going to politely say, why not do it the last year you own the business to show that person, yes, you really can. This is really a discretionary line, and therefore don't make it the last year when you're selling the business or before you sell the business, and clearly show that is a profit that can be had. Or, you know, if you say that the owner compensation, you know, you can replace me for $150,000, the right answer may be make the owner comp the $100,000 or the $150,000 that you think you could be replaced for, so that you truly do show the business is profitable on your tax returns and everything else. It's, you know, at the very least you want to paint the picture unequivocally if you're selling a business. Here's where the money's at. You know, and maybe at the most you actually want to show that, yeah, these really are discretionary, that we really can keep our employees without making these kinds of things. We did it because, you know, we like our employees, their friends, their colleagues, the like. But, you know, if a third party is likely to do it anyway, why not demonstrate it so all third parties really believe that it is a discretionary expense and bid accordingly for your company? So, question has been raised. Is that Mel?
No, not me this time.
Okay. I might, maybe I haven't cleared out from the last time. We'll clear the question out. Anyway, so there's a lot. I do look at people to get them to, sort of clean up their income statement, if you will, set expenses of reasonable levels if you want to, if you want to sell for the highest and best price, show the profit as best you possibly can, whether it's compensation, whether it's benefits, whether it's other discretionary items. Okay, let's go to the other example that I had, Chris, it's an adjusted income statement. Okay. Perfect. Hold on to this one for a minute. And I guess I'll contrast another thing when I talk about cleaning up your income statement or your balance sheet. Yes, when you go to sell your company or whether you do an ESOP, you're going to look at and say, we're going to try and adjust for all these non-recurring items, and you're going to have your investment banker or whoever is selling your company is going to put together an adjusted income tab. Well, if you constantly have non-recurring items or gain or loss on asset sales or all these items in and year out or discretionary items, I guess I'm going to say that, you're particularly if there's a non-recurring item for a bad debt or an inventory charge or, you constantly have a $200,000 this or a $150,000 that year in and year out, sooner or later the buyers are going to say, gee, am I really getting these adjusted earnings, or are they always going to have something come along year in and year out, so I'm not going to see the adjusted earnings, I'm going to see, $200,000 less. Go back to the prior page, Chris. And I guess contrast, for those of you following along, contrast the prior page where I had 3, 4, 5 adjustments every year to my income statement to this client of mine that I have no items adjusted for every year. And imagine which one you think is going to get a higher multiple for the folks that don't have any non-recurring items happening year in and year out. The point being is, if you have some bad inventory, if you have some bad debts that might be charged off, if you have some other things in the balance sheet or the income statement, and you're thinking about selling 2 or 2.5 years from now, why not get them out of the system now? Take the charges this year, and then if you're going to, then if you're selling, towards the end of 2010, 09 will be a clean year, 010 will be a clean year, and I think you'll have people looking at you a little differently of, geez, they got some nice, very clean results, versus constantly having baggage in their results year in and year out. That's sort of the second part of this. Okay, back to the Excel spreadsheet.
Okay, which back to the slides?
Yes, please.
Okay.
Okay.
They should be back up.
Yeah, I'm trying to make sure I'm on the right one. After you clean up your income statement, I'm also going to suggest clean up the balance sheet, if you will. And what I mean by that is a couple of things. One, I talked about inventory, bad debts, receivables, things like that. But also, if you're looking to sell the company, and you own the lot next door that's 5 acres, and you use 4 acres, you have 10 acres total, you only need 5 for your business, and you have the 5 acres next door. Should you subdivide the lot so that you can sell the business as it is and sell the 5 acres separately later? Is your buyer going to just take the 10 acres and you're giving them the 5 extra acres where you might be able to subdivide that, split it up, and get some extra value out of it? Things like that. If there are personal assets in the business, make sure you identify them so that you can see that the buyer's not thinking about what they're getting, or you're not giving them $100,000 of various items that are there. If you have some old tooling, if you have some old things that you can probably sell and get some money out of that the buyer's just going to look at and say, seeing on the shelf, clean it up. See if you can turn it to cash. If it's not worth anything to your buyer, but it is worth something to sell or to you, go ahead and realize the value. Get your balance sheet in order so it looks cleanest. And by the way, if you wind up getting rid of this $100,000 of tooling that they don't want, when people go through your facility, it's going to look a lot cleaner and a lot more organized. So those types of things can be done. More interestingly, think about what your balance sheet looks like in the year or two before you're doing want to go sell the business or even sell to your employees. When you're thinking about capital asset planning, and if you have a $500,000 machine to buy that's something you only buy one every 6 or 7 years, and you want to sell your business next year, you know what? Maybe you defer buying that $500,000 piece of equipment, because what's going to happen is you're going to buy that piece of equipment, and you're either going to have $500,000 less cash that you can take off the business when you sell, or you're going to borrow $500,000 to do that. And the seller's going to look at you and say, well, I'm buying the company or I'm buying its assets. You're responsible for all the bank debt. Well, you just incurred $500,000 of bank debt. Likewise, you're going to put that new machine in and spend 6 months getting it up and operating, so your results aren't going to be as good on the income statement then. And by the time what's going to wind up happening is you're going to wind up selling the company. You're going to take the hit for this $500,000 of debt. And about the time you close on the transaction, or 4 to 6 months later, this new machine is going to be doing all the things you ever hoped it would do, and all that profit's going to go to the buyer, and you're going to have paid for it a couple times over. A little more aggressive is, do you think about working capital? And the easiest example of this is, are you very aggressive at paying your payables? And what I mean by that is, I have clients that pay me in 5 or 10 days, and I thank them dearly, remind them often how much I love them. But if the buyer's going to come in and pay their receivables, and everybody's normal terms are 30 days, and 30 days receivables means 30 days payables means your payables are $800,000 instead of $400,000. Maybe you want to start paying things in 30 days. And all of a sudden you'll have an extra $500,000, $400,000 of cash that you can take off the business, or you'll have $400,000 of less debt, and you'll wind up with some more money as you clean up your working capital. If you've been a little lax at collecting some things, maybe it's time to bring those clients that are out there at 70 days down to 60 or 50 if you can, in order to try and get some more cash in. Look at all the aspects of your balance sheet as you're getting ready to. And I guess, by the way, if you're doing planning for estate and gift, the reverse is also true. I've seen more than one divorce valuation over the years where the payables, start to get very nice and lean as they're getting ready for divorce, and cash gets spent down, or CapEx gets spent during that period, or advertising expenses go way up, or some other things go way up, that all of a sudden the business isn't quite as profitable, or has less cash, or has more debt. The goal is, figure out what your long-term goal is and start making your income statement and balance sheet look accordingly. Also want to do some income tax planning as you're doing this. And what I'll mean by that, and this also goes with corporate planning as well. And I'm going to kick over to one more example here. And this applies to both tax planning and corporate planning. Because most of the time when we meet people that are getting ready to sell their business, they have a certain expectation. If somebody's told them they're going to get $5 million for their company in a sale, they think, okay, they're going to be in the expect column. Okay, my sales price is $5 million. Yeah, maybe I have to pay 2 to 4% to the broker that's helping me sell it, but I'm going to wind up with about $4.8 million and then maybe pay a little capital gain on that, but I'm going to wind up with a pretty big number at the end of the day. And many people forget about the income tax at the individual level anyway. Well, I guess I'd like to point out to everybody that depending on what your transaction is, your net proceeds may be radically different than you think, and we want to sort of walk through that. For example, shift from the expect column to the stock sale, and very few companies worth less than $25 million get done as stock sales unless we're an ESOP. Unless you're talking about selling to an ESOP. And so, okay, in a stock sale, if they tell you you're going to get $5 million for the business, and you quickly say, is that total invested capital or equity? And the broker says it's a stock sale, it's equity. Your sale proceed is going to be $5 million. Now, I'm guessing the broker is going to charge you a commission on both the sale proceeds and the amount of debt the buyer assumed. because they're going to say they got you $7 million of total invested capital. And I finally, after 20 years in the business, had an investment banker explain it to me in a way that I didn't at least sort of want to smile while they were talking, that it's just a way to get a higher commission. And the final explanation that made sense was, if you were to sell your house and the sale proceeds are $300,000, but you owe a $100,000 mortgage on it, you only get $200,000 for the after the mortgage is paid off. But the house was worth $300,000, and they want their commission based on the $300,000 the house is worth. Similarly, for better or worse, the broker's going to want their commission on the value of the equity and maybe the debt they relieve you of as well as part of a sale. So you're probably going to pay a commission on $7 million, even on a stock sale, when you get $5 million proceeds. Now, the more likely scenario for small companies is an asset sale. And what that means is you take your XYZ company, and the buyer's not going to buy the stock from you. They're going to say, I just want to buy the assets of the company, including all its goodwill, its trademarks, all its intangible assets. But I don't really want to assume everything you've done that could potentially come back as a liability to me later, i.e., if there's a bad transaction, if there's any number of things, if there's product liability from something you sold 10 years ago, if there's anything bad out there, I don't want it. So I'm going to buy your assets, and I'm going to leave you with all your historical liabilities. Well, if you're a C or an S corporation, you're going to get a radically different number out of the result. First of all, if they tell you the sale price is going to be $5 million, and even in an S corp, you sell your assets for $5 million, you pay the broker maybe a 4%, maybe less commission, and you wind up with a net sale of about $4.8 million. Remember, we talked earlier about the broker will tell you the total invested capital number that they're going to get you. Well, you can't spend total invested capital. You can spend equity. So after the asset sale, you're going to have to pay off all your own debts, bank debts generally. Lots of times a buyer will assume your payables or assume, all your normal business expenses because they want to assume the supplier relationship, and they'll buy the receivable anyway that goes with your customers. But they're still going to say you go ahead and satisfy any bank debt or any deferred compensation agreements or sort of any of those kinds of things. So you're going to have to settle up with the bank if you have $2 million of credit out to the bank or a deferred comp agreement or anything, and your net available to shareholders is only going to be maybe $2.8 million, not $5 million that you heard. And then obviously you still have individual income taxes to pay. It might not be so great here because as an S corp you'll tend to have basis in the stock as an individual, and so your reported taxable gain may not be as high and your taxes might not be as high. That's something I can't tell for anybody that's listening as to how big your individual taxes will be, other than there's something out there to remember on your 1040. And then the worst possible scenario is a C corporation asset sale. And the reason I say that is you start with your $5 million sale price and pay the broker their commission, so you're down to a net sale of $4.8 million. But the corporation is selling the assets at this point, and as a C corp, it's a taxable corporation. So the difference between whatever your basis in those assets, generally some resemblance to your book value, and the sale price is going to be a taxable gain to the corporation. So you're going to, before you even can distribute money out to the shareholder, your corporation is going to sell all its assets and report gains on that, and in its final taxable corporate return, let's say it gets $4.8 million, but our basis is only $1 million, our book value, we're going to have a $3.8 million taxable gain and report, maybe a 35 or a 40% cap gain rate at the corporate level. Send that money to Washington, and that may only leave you with maybe $1.8 million available to distribute out to your shareholders. And just to add a little insult to injury, there still is individual income taxes on the $1.8 million. So here's where, looking at getting your estate planning or your income tax planning in order, or getting your corporate structure right so that you have the expectation of, you may have a $5 million sale expectation, but what are you going to wind up with at the end of the day?
Dave?
And we are winding down to the end of our hour.
Yes, we're right at the end.
And I've got one slide, so I think I did all right. Basically, the last slide is to talk about preparation, and that is, talk to your advisors about tax planning. Talk to your people about positioning the business. prepare to show the company off. And this is pro or con. If you get the business in position for an estate planning. Pretty much the last slide I shows you why from a dollars and cents standpoint. Do we have any other questions or thoughts before we conclude?
Yeah, I wanted to make sure, open up the field. Any questions? Okay, what I've done here is I've gone back to the first slide so you can get Dave's contact information. If you want to contact him, you can find it there. If there's no other questions, I'll ask one last time if there's any questions by anyone out there.
Otherwise, I'd like to thank you for your interest, and as I said, don't be shy about give me a call, send me an email if something occurs to you as you're planning. I'm happy to follow up with everybody if it's something more private than you wanted to open up on a mic that's being recorded, something private about how your business runs. Let's talk about it. I'd be happy to.
All right, great.